Uh, Good afternoon, ladies and gentlemen. Welcome to the 14th KIEP-IMF Joint Conference. I'm Sarang Song, a researcher of International Finance team at KIEP. For your reference, we provide simultaneous interpretation both in Korean and English. Before starting the session, Dr. Seoul Lee, President of KIEP, will provide an opening remark. So please welcome him with a big round of applause.
Good afternoon, honored guests, ladies and gentlemen. Welcome to the 14th KIEP-IMF Joint Conference. First of all, I would like to express my sincere gratitude to all the session chairs, speakers, and discussants. Special thanks goes to Dr. Johannes Wiegand and Dr. Alastair Scott from IMF for their extensive support in making this timely event possible. Following the U.S. presidential election, the global economy is expected to undergo a wide range of changes. The year 2024, known as the year of global elections, has reaffirmed the ongoing intensification of nationalism, as you can see in the result of the U.S. election. In the aftermath of the election, U.S. financial market experienced gains in the stock market and the treasury yields, along with a stronger dollar, while many other countries saw notable declines in their stock market and the currency values. Around the globe, nations are now closely watching President-elect Trump, his administration's appointment, and his policy agenda. This year, while many countries, United States, United Kingdom, and the Eurozone have been gradually cutting interest rate, Japan has taken a different path by raising interest rate twice, which highlights a divergence in monetary policy across countries. In early August, this shift triggered panic in both domestic and the global financial market. Concern of a potential U.S. recession, combined with Japan's unexpected rate hike at the time, caused global stock markets to plummet, and the yen and the dollar to surge sharply, and other currencies to weaken significantly. Today, the World Economic Outlook, actually released by the KIEP in this November, project global economic growth of 3% in 2025, marking a slight slowdown compared to this year. This forecast represent 0.2% percent point downgrade from the May projection of this year, reflecting the concerns that the Trump administration's second-term policies, such as tariff increase and protectionist measures, could somewhat dampen international trade and investment. KIEP has highlighted intensifying Trumpism, deepening growth divergence as the key theme for the global economy in the 2025, with the Trumpism referred to the American First policy. Domestically, this reflects right-wing populism, while internationally, it emphasizes the non-interventionism and protectionism. President-elect Trump's major campaign promises, including, again, this tariff increase, tax cut, and the deportation of illegal immigrants. Depending on how these policies are implemented, the U.S. could see continued growth while other nations experience a slowdown. And other major downside risk to global growth that we identify include a further slowdown in Chinese economy due to internal and external challenges, as well as the potential for increased financial market volatility with the monetary policy shift and the rising real debt burden. In session 1 of today's conference, we will discuss the global and the Asian economic outlook in the next year, along with the key challenges facing the Asian region. In the second session, we will explore the main drivers of a medium and long-term growth in Asia. Although the year 2025 will bring significant challenges for the global economy, we should use these challenges as opportunities for future growth and innovation. We'll be discussing these issues and many others throughout today's conference. Once again, I would like to thank all the participants and the audience for joining us today. Thank you very much.
Thank you. Now we will have a photo session, so please come forward and stand on steps in front of the podium. The first session, World and Asian Economic Outlook for 2025. Dr. Young-Sik Jung will be a moderator for the section. He is a Director of International Macroeconomics and Financial Department at KIEP. Dr. Jung, the floor is yours.
Thank you. Thank you, Dr. Song, for the kind introduction. Good afternoon, everyone. So my name is Young-Sik Jung from KIEP. It's my pleasure to moderate the first session of today's KIEP-IMF Joint Conference. The topic of this session is World and Asian Economic Outlook for 2025. As we look ahead, the year 2025 is shaping up to be one of heightened uncertainty. In October, IMF identified a policy pivot, rising threat, as the key theme for global economy in 2025. Shortly after the US presidential election, KIEP highlighted intensifying Trumpism, deepening growth divergence as the keyword for the global economy in 2025. Last week, the OECD described 2025 as keyword, 2025 as the time of resilience in uncertain times. Across all these perspectives, one thing is clear: uncertainty and emerging threats will play defining roles in shaping the global economy. At the same time, Asian region continues to attract attention as a vital engine of global growth. In the first session, we have two distinguished experts who will share their insight on the global and Asian economic outlook for 2025. Before we begin, let me introduce our esteemed presenters. Dr. Yoon Sang-ha, he is the head of International Macroeconomics team at KIEP. Dr. Johannes Vigant, right pronunciation, okay. He is the chief of the regional study in the Asia and Pacific department at the IMF. Each present will have a 20 to 25 minutes for their presentation, followed by a brief Q&A session. Without further delay, let's start with our first speaker. Please join me in welcoming Dr. Yoon Sang-ha. Please give him a round of applause. He will present on 2025 World Economic Outlook. Dr. Yoon, the floor is yours.
Good afternoon, everyone. My name is Sang-ha Yoon, Head of International Macro Team at Korea Institute for International Economic Policy. During about 20 minutes, let me present World Economic Outlook, which was published on November 14th by KIEP. This work is not my own and has done by the Economic Outlook team of KIEP led by Dr. Young-sik Jung over there. And the contents will be the overview of the World Economic Outlook, international finance and oil market, and outlook for major countries and regions. To begin, let's take a look at the key highlights of the 2025 World Economic Outlook. Global economic growth is projected to slow to 3.0% in 2025, marking a continued deceleration from previous years. This decline reflects a mix of structural and cyclical challenges across both advanced and emerging economies. On this slide, you will notice the breakdown of growth projections by major economies. The US and Euro area are expected to grow at 2.1% and 1.3% respectively, while China's growth is projected at 4.1%, a significant slowdown for the world's second largest economy. On the other hand, India stands out with a strong growth forecast of 6.8%, supported by robust investment. ASEAN 5 countries will benefit from continuing inward FDI, marking 4.7% of growth next year. On the other hand, growth rates of Russia and Brazil will be slowed further compared to those of 2024. This downward revision is emphasizing the ongoing recovery challenges. This slide illustrates the adjustments in the global economic projections for 2025, comparing the estimates made in May 2024 with the latest updates as of November 2024. You can see a downward revision of 0.2 percentage points in global growth, reflecting heightened uncertainties and emerging risks. Among advanced economies, the US growth rate is revised upward thanks to the recent robust consumption and employment, while inflation has been stabilized. On the other hand, the Euro area faces mounting pressures from restrictive fiscal policies, high production costs, and low productivity growth. In emerging markets, while India and ASEAN 5 countries remain resilient, China have been revised down quite a lot due to domestic economic challenges and increasing geopolitical tensions. Here, we compare the projected growth rates for 2025 with the pre-pandemic average between 2015 and 2019. This comparison underscores the significant headwinds many economies are facing in the current global economic environment. The global economy is projected to grow at 3.0% in 2025, as mentioned earlier, and this growth rate is well below the pre-pandemic average of 3.4%. The most notable slowdowns are seen in the Euro area and China, while emerging markets like India and ASEAN 5 countries will catch up the pre-pandemic average. These trends highlight the long-term structural issues compounded by pandemic after effects, geopolitical uncertainties, and changes in global trade dynamics. And these trends can also be observed through the long-term economic growth trajectories of major global economies. Among advanced economies, The United States is leading global economic growth, while India stands out with remarkable growth among emerging markets. Notably, since 2018, when tariffs and trade restrictions against China were intensified during Trump's first administration, U.S. growth has accelerated, whereas the growth rates of EU and China has shown a gradual decline. Under the second Trump administration, protectionist policies such as tariff and supply chain restructuring could introduce significant volatility not only in the U.S. but across global trade networks. The key phrase that captures the essence of the global economy that KIEP suggests is intensifying Trumpism, deepening growth divergence. Trumpism can be summarized as America First, which fundamentally pursues righting populism domestically while advocating non-interventionism and protectionism externally. Policies such as tariff increase, tax cuts, and deportation of illegal immigrants exemplify this approach. The unfolding of America First policy suggests a scenario where the U.S. continues its relatively strong growth trajectory in the near term, while targeted sanctions and competition could further suppress growth in other economies, deepening the divergence. The key risk factors for the global economy moving forward can be summarized in three major points. First, the advent of the new U.S. administration and the intensification of protectionism and America First policies. Trump's policies are thoroughly focused on protectionism and America First, encompassing tariff hikes, tax cuts, and deregulation, deportation of illegal immigrants, reshoring-centric supply chain policies, and fostering the fossil fuel industry. Trade pressure on China and allied nations is expected to increase significantly. While the baseline scenario involves a phased implementation of protectionist measures and tariff hikes by the United States, scenarios involving retaliatory tariffs from China, further escalation from the United States, and a full-blown trade war cannot be ruled out. It is also important to note that the impact of Trump's policies vary by industry and region. Second, economic shocks stemming from domestic and external risks facing China. Chinese economy is grappling with structural risks such as a real estate market slump, local government debt issues, and population decline domestically, while externally facing reduced foreign direct investment and intensified U.S. containment under the new Trump administration. In response, the Chinese government has announced large-scale stimulus measures and stabilization policies, including fiscal policies like special treasury bond issuance and local government bond utilization, liquidity expansion such as reserve requirement cuts, and relaxed regulations in the real estate sector. However, these measures are more focused on stabilization rather than robust economic recovery, and it will take time for them to function as effective policies. If China's risks materialize, they could have widespread spillover effects on the global economy through trade and financial channels. Third, increased financial market volatility and rising real debt burdens during the transition in monetary policy. As global inflation stabilizes downwards, major economies are transitioning their monetary policies from tightening to easing, leading to heightened uncertainty. In the United States, fiscal stimulus driven by the new administration's tax cuts and tariffs may raise import prices, potentially slowing the pace and scale of the Federal Reserve's rate cuts. Conversely, the Bank of Japan is likely to further raise interest rates. While many countries are cutting rates, real interest rates remain high, exacerbating real debt burdens. Additionally, Japan's rate hikes could lead to the unwinding of yen carry trade, increasing financial volatility in emerging markets vulnerable to capital inflows and outflows. Let me begin with the outlook for international financial commodity markets. The financial market is particularly significant as it tends to reflect expectations about Trump's election and policies most quickly. This year, most countries and regions worldwide, except for Japan and Turkey, have cut their policy rates at least once. As shown in the graph on the right, this is largely due to declining inflation in both global and the United States markets. It is worth noting that the global inflation rates remain approximately 1.5 times higher than pre-pandemic levels. In the case of the United States, while headline inflation is converging to pre-pandemic levels, core CPI and core PCE remain elevated. Another notable trend during Trump's first term was that headline inflation outpaced core inflation. This appears to be less attributable to tariff effects and more influenced by weaker pressures in service prices and labor market tightness. Turning to sovereign bond yields, we see heightened volatility across major economies, reflecting the ongoing uncertainty in the global economic landscape. The U.S. Treasury yields are expected to experience increasing volatility depending on the intensity and timing of policy implementation under Trump's second administration. This is largely due to the likelihood of higher inflation and an expansion of Treasury issuance driven by fiscal deficits. However, given the slowdown in the U.S. labor market and economic growth, additional rate cuts, albeit weaker than initially anticipated, are expected, which may lead to a gradual decline in Treasury yield. In contrast, the euro area is likely to lower rates further in response to economic stagnation and a slowdown in inflation. Meanwhile, Japan is expected to take a different trajectory with a potential for additional rate hikes depending on the recovery in real wages and movement in the yen-dollar exchange rates. The U.S. dollar is expected to maintain a strong position in the near term due to the market expectations surrounding policy implementation under Trump's second administration. However, as concerns about economic slowdown grow, coupled with potential policy adjustment and further rate cuts, the strong dollar trend is likely to ease. While Trump's policies could support the dollar, they also risk exacerbating economic slowdown. Additionally, restrictive interest rate levels and a softening labor market are likely to heighten concerns about the economic downturn, increasing the possibility of rate cuts and policy moderation. Furthermore, some Trump-affiliated policymakers have argued against a strong dollar to enhance manufacturing competitiveness and reduce trade imbalances, which could further contribute to the weakening of the dollar. And during the Trump's first administration, the U.S. designated China, Vietnam, and Switzerland as currency manipulators, intensifying pressure on countries with trade surpluses against the United States. Similarly, these dynamics may influence the dollar's trajectory in the future. For the Korean exchange rate, it is expected to remain high in the near term, reflecting the dollar's movement. However, as U.S. policies are moderated and expectations for rate cuts grow, the exchange rate is likely to decline. Korea's inclusion in the World Government Bond Index is projected to bring in approximately $560 million of bond inflows from November 2025 onwards, contributing to supply-demand balance and interest rate stability in the domestic bond market. Additionally, Korea's large current account surplus and its substantial net foreign financial assets are key factors that will support the stabilization of the Korean won exchange rate. Oil prices are projected to gradually decline within the $65 to $85 range, driven by the weakening global demand and increased production from non-OPEC plus countries. Policies from the second Trump administration, which include stronger fossil fuel support and deregulation, are likely to further boost the supply. However, the situation remains highly volatile due to the geopolitical risks, particularly in the Middle East. Any escalation in regional tensions, such as a potential Strait of Hormuz blockade, could push prices above $100 per barrel. Now let's move to the outlook for the major economies. The United States continues to anchor global economic trends with projected growth of 2.1% in 2025. This moderate growth reflects a combination of resilience and challenges. Private consumption remains a key driver, supported by a favorable labor market and asset price appreciation. However, restrictive interest rate level will lower the consumption growth. The Federal Reserve's rate cuts, while helpful, have not fully alleviated the tight financial conditions. Under the second Trump administration, protectionist measures such as new tariffs and reshoring initiatives are reshaping trade flows and supply chains. These policies may provide some short-term domestic benefits, but come with longer-term risks, including higher consumer prices and retaliatory measures from trading partners. Notably, the U.S. fiscal policies such as early tax cuts and increased infrastructure spending will likely boost investment in the near term, though uncertainties around implementation timelines remain. In the euro area, growth is projected at a modest 1.3% for 2025, reflecting both cyclical and structural challenges. Recovery is primarily driven by stabilizing prices, real wage growth, and improved financial conditions, which support private consumption. However, Germany, which accounts for 30% of the Eurozone economy, faces significant headwinds from low productivity growth, weakened price competitiveness, and high dependency on trade with China. Additionally, the implementation of the excessive deficit procedure has resulted in fiscal tightening across several member states, further limiting growth potential. Japan's economy is projected to grow at 1.0% in 2025, driven by increased investment in next-generation industries and supportive economic policies from the new cabinet. While growth shows signs of recovery, challenges persist. Exports face downward pressure due to global uncertainties and potential new tariffs from the United States. Meanwhile, unsustainable real wage growth tied to rising energy prices may dampen private consumption in the long run. China is projected growth of 4.1% in 2025, represents a significant slowdown from its historical perspective, reflecting both domestic and external challenges. On the domestic front, recent stimulus measures, including reserve requirement cuts, fiscal support for local governments, and real estate market interventions, have focused on stabilization rather than substantial economic recovery. These policies have seen limited success in boosting consumer confidence and long-term investments. Externally, decoupling pressures from the United States remain a major concern. With the Trump administration expected to maintain or even increase tariffs and sanctions, over 60% of China's U.S.-bound exports could be affected. These measures not only weaken China's trade position but also disrupt global supply chains. China's government is also grappling with structural issues, including a high debt burden, demographic challenges, and sluggish productivity growth. While its effort to diversify trade relationships and strengthen domestic demand are ongoing, these initiatives require time to yield significant results. India's robust growth projection of 6.8% in 2025 stands out, driven by strong investment flows, private consumption, and agricultural production. Foreign direct investment plays a critical role in India's success story. The country has become a magnet for high-tech and digital industries, attracting significant investment from the US, Japan, and other advanced economies. For example, sectors like computers, other services, trade, construction, and communications have seen rapid expansion, bolstered by supportive government policies. India's Make in India strategy further positions it as a preferred designation for global supply chains seeking diversification. Additionally, India's domestic reforms, including infrastructure development and ease of doing business initiatives, create a conducive environment for sustained growth. However, challenges such as uneven income distribution, lack of infrastructure, and inflationary pressures remain areas of focus. The ASEAN 5 countries, Indonesia, Malaysia, the Philippines, Thailand, and Vietnam, are projected to grow at 4.7% in 2025, supported by a mix of FDI inflows, private consumption, and infrastructure investment. A key driver of ASEAN 5 success is its strategic positioning in the global supply chain. As companies seek alternatives to China, countries like Vietnam and Malaysia have emerged as attractive production hubs. For example, Vietnam has seen significant investment in electronics and manufacturing. Big portion of FDI inflows of this region comes from the United States and China. Tourism recovery is another critical factor, particularly for countries like Thailand and the Philippines, which benefit from increased global mobility and pent-up travel demand. Infrastructure projects such as Indonesia's new capital city development further contribute to the region's growth momentum. Despite the positive outlook, ASEAN 5 countries face challenges, including external uncertainties such as protectionist risks from the United States and regional geopolitical tensions. However, the region's geopolitical importance helps mitigate these risks. Russia's growth is projected at a modest 1.7% in 2025, constrained by severe supply-side limitations and external pressures. Key challenges include an aging population, a shrinking labor force, and the ongoing impact of economic sanctions and export controls. Additionally, reduced oil and natural gas prices combined with limited production capacity have further weakened economic momentum. On the positive side, increased government spending, particularly on military expenditures, is providing some short-term support to consumption and wage growth. However, the structural issues facing Russia's economy remain profound. Brazil's growth is projected at 2.0% in 2025, supported by new industrial policies and stable private consumption under the Lula administration. Efforts to boost purchasing power through minimum wage hikes and low-income support measures have helped sustain domestic demand. However, growth momentum is expected to slow due to inflationary pressures, tight monetary policies, and fiscal consolidation effort. Brazil's resilience on commodity exports remains a vulnerability, with declining global prices weighing on export revenues. Fiscal discipline will be the key to ensuring sustainable growth in the years ahead. With this, we conclude our review of our major economies. To conclude, let me briefly summarize the key insights from today's discussion. The global economic outlook for 2025 presents a mixed picture characterized by slowing growth, deepening divergences between advanced and emerging economies, and significant policy changes. The key factors shaping this outlook include the impact of protectionist policies, particularly from the United States, on global trade and supply chains. Persistent structural challenges in advanced economies like the Eurozone and Japan, coupled with external pressures on major emerging markets such as China and Russia. And resilient growth in economies like India and the ASEAN 5 countries, driven by investment, consumption, and their strategic positioning in the global supply chain. So policymakers must navigate these complexities with a focus on fostering economic resilience, enhancing structural reforms, and promoting global cooperation to address shared challenges. I want to thank you all for your attention and engagement today. Thank you very much.
Thank you, Dr. Yoon, for your valuable and insightful presentation. Dr. Yoon highlighted a key trend for 2025, noting that while global growth for 2025 is projected to slow compared to this year, growth patterns are expected to diverge significantly across country. For instance, the US is projected to maintain solid growth, while China's growth may weaken, which is different from the OECD views. Thanks once again. The next speaker is Dr. Johannes Wiegand. Please give warm welcome to Dr. Wiegand. So you have the floor. So he will present on regional economic outlook for Asia and Pacific.
Yeah, thank you very much. So before I start, let me thank KIEP and the organizers for the very generous invitation to this wonderful event. It's a great pleasure, a great honor for me to be here. Second, I would like to apologize for my appearance. So as you see, I'm without a suit jacket. It's not because of disrespect, it's because I had a packing accident, as a result of which I ended up with non-matching pants and jacket. And faced with the choice whether I keep my jacket or my pants, I opted for my pants. I hope you forgive me for that. Yeah, my name is Johannes Wiegand. As said, I'm the chief for regional studies in the regional studies division in the Asia Pacific department of the IMF. I will now present our regional economic outlook. It's mostly the outlook that we published on November 1st. So that means we publish it before the US elections, but I have updated the presentation recently, so it's not exactly identical to the one you have in your slides, and also added a couple of charts in order to discuss more recent developments. So let me see whether I can get this to work. Yeah, very good. So let's start with recent developments. On the left-hand side, you see growth outcomes of Asian economies through the third quarter of 2024, relative to the forecast we at the IMF had done in April of this year. So we publish our World Economic Outlook twice a year, so this is our April forecast. And as you see, through the third quarter, most economies actually outperformed our growth forecasts. There are a couple of exceptions, but most economies surprised overall on the upside. The picture was even clearer through the second quarter, so it has become slightly more diluted through the third quarter, but overall you would probably conclude that so far 2024 has been a relative good year for Asian economies. On the right-hand side, you see a standard demand-side decomposition of growth into different factors. It shows first the first half of the year, the first 6 months of the year, and then the third quarter. I think what you see is that in the first half of the year, growth was quite dependent on net exports. It's positive, or at least non-negative, in the majority of countries and country groups. Net exports, of course, over time should cancel out to zero. That means there was a significant growth impetus from the external sector for Asia in the first half of the year. In the third quarter, the picture is a bit different. In some countries, net exports continue to drive growth, but there's also a very strong component of domestic investment. And interestingly, all across Asia, we are not quite certain what is behind that, but it's an interesting fact that we observe for the third quarter of growth in Asian economies. On this chart, we look a bit more into components of growth. So on the left-hand side, you see the external sector, you see exports. And we wanted to understand sort of what has been driving the strength in exports in the first half of the year. And interestingly, what we observe is that sort of the source of strong exports hasn't been the same across Asia. For example, China exported particularly strongly to emerging economies, both inside and outside of Asia, while the Asian 10 economies exported particularly strongly to the United States. And that's something I'll get to a bit later in the presentation. On the right-hand side, you see retail sales, so a proxy for private consumption. And I think what stood out until recently is actually still stands out, is the weakness in private demand in advanced Asian economies, so including Korea. Our hypothesis is that this relates to the monetary policy stance in many of these economies, which is weighing on domestic demand. But you see that in emerging Asian economies, domestic demand recently has also slowed quite significantly after contributing quite robustly to growth in the early months of the year. Let's turn to inflation. Here, the bottom line is that Asia disinflated much more rapidly than other parts of the world and has basically returned to inflation targets. Disinflation, interestingly, was particularly fast in emerging Asian economies. Their inflation had returned to policy targets in the majority of countries already by the end of last year. In advanced Asian economies, that was not the case. And the reason for that was elevated services inflation. So services inflation have a strong wage component. Wage pressures were quite high through the first half of this year, partly reflecting attempts by workers to recover the real income losses they had endured during the post-COVID inflation years. But you see in recent months, services inflation has also come down quite sharply in advanced Asia, and as I will show later, also advanced Asia is now basically back to inflation targets. A couple of external developments. These often tend to get a lot of scrutiny. First, on the left-hand side, you have inflation developments. Here you see that in the, developments have really changed over time. So first, you know that from about the middle of the year, there was suddenly strong appreciation pressures in Asian currency. Now let me go one step back. In the beginning of the year, there were depreciation pressures of Asian currencies. That was the time when the Federal Reserve signaled it would keep policy rates high for quite a bit longer. These then suddenly reverted in the middle of the year, and Asian currencies appreciated quite significantly. But in recent months, again, Asian currencies have again regained some ground, lost again some ground vis-à-vis the US dollar. That started before the US election, but has continued afterwards. On the right-hand side, you see a development that is of quite a bit concern for us. This is the amount of trade restrictions imposed all across the world. And you see the great increase in trade restrictions from about the COVID pandemic. But you also see that 2024 promises a record year in terms of new trade restrictions imposed, and I will discuss later why we consider this a problem. Financial markets development, this is also a little bit to see how markets reacted to the outcome of the US elections and whether there has been an impact on Asian financial markets. I think the broad picture is there was an impact, but it was quite short-lived and very modest. So you saw some decrease in equity valuations in some countries. You saw some increase in local currency yields. But overall, these have been very modest compared to financial market developments earlier in the years. It seems that financial markets are still about to figure out what to make of the outcome of the elections. Let me now move to the outlook. I first start with our growth projections. This is often what catches the most the interest of the press. We sometimes regret that a bit because we do not think that our relative strength is projecting growth by the decimal point, but more sort of to analyze the economic trends and policies behind it. But this here is the bottom line. I think if you want to have the key message, look at the second column, and you see that we upwards revised growth slightly for Asia, both in 2024 and in 2025. In 2024, that's basically the result of the strong performance in the first half or the first 9 months of the year, which carries over into the figures for the entire year. For 2025, there are a range of factors. One of them is that our China desk expects stronger policy support in China, which would boost growth. But it's also the expectation that more accommodative monetary policies in Asia could support domestic demand going forward. This year characterizes a bit the external environment and looks a bit more into details of growth drivers. On the left-hand side, you see the main trading partners for Asia, and you see really minor revisions relative to what we had in April 2024. United States is expected to slow, so is China. Euro area is expected to strengthen from a low level. Fundamentally, these forecasts have changed little. In terms of growth drivers, I think the bottom line is that we expect the composition of growth in 2025 to remain very similar compared to 2024. We expect some strengthening of growth in Asia. We expect growth in advanced Asia to become less dependent on external demand, but these are relatively minor changes. Turning to inflation, so the left-hand chart illustrates what I already emphasized earlier. So this shows the difference between actual inflation and central banks' inflation targets. And you see the green bars are emerging economies in Asia. you see that already by the end of last year, inflation rates in emerging Asia had returned to policy targets, and now on average they're actually below policy targets, average inflation rates. For advanced economies, inflation was still quite elevated by the end of 2023, but given the disinflation on services in recent months, this has also changed now, and advanced economies essentially have returned to policy targets as well. On the right-hand side, you see individual economies. There are a couple of economies where actually you would be more concerned about inflation being too low rather than too high, and these include Thailand and China. Risks to the outlook. So let me start with the external environment. On the left-hand side, you see proxies for global demand, and therefore proxies for export demand for Asian economies. And these have been pointing downwards since about the middle of the year. So that started well ahead of the US elections or other recent events. And that, of course, is not necessarily positive news for a region so dependent on exports and integrated into global trade. On the right-hand side, you see metrics of financial market volatility. The red line shows an index of general volatility that spiked, as mentioned earlier, in late July, early August, when expectations about the course of the Federal Reserve changed very violently. One country that was, for example, strongly affected was Japan, where many carry trades with the yen as funding currency unwound, but that situation stabilized relatively soon thereafter, and volatility since has come down again to more modest levels. However, currency volatility in Asia also increased at about the same time, and that has remained high. Now, one factor, important factor for the region is, of course, China. And as you all well know, the Chinese economy in recent years has gone through a protracted adjustment of the property sector, which has been weighing on confidence, which has been weighing on domestic demand, and which has also been weighing on prices. And you see that on the left-hand side. So export prices in China, actually the growth rate of export prices has been negative for most of the past year. We did some analysis, not in this regional economic outlook, but of the one in April, where we showed that this can spill over into neighboring economies, especially economies with a similar export structure. Their exporters could come under pressure both on the price and on the quantity front. But China can, of course, also be a source of positive spillovers, and one example for that you see on the right-hand side that shows tourist arrivals from China to other Asian countries. And you see that compared to 2023, tourism has greatly recovered. It's not quite back to where it was before the pandemic. That would be 100, but it's getting close to it, and in some countries actually very close. It shows whatever supports domestic demand in China at this juncture is not only good news for the Chinese economy, it is also good news for Asian economies overall. Here I return to trade patterns, so something I touched upon earlier. On the left-hand side, you see how relative trade patterns have shifted in the past 5 years. And you see quite significant developments. For example, on the left-hand side, you see that China now exports much more to emerging markets, both in Asia and outside Asia compared to 5 years ago. It exports less to advanced economies, and not only to the United States, where maybe you would expect that, given trade tensions between these countries, but also to advanced economies in Asia. So China exports less than 5 years ago. Interestingly, for the ASEAN 10 economies, the pattern is quite different. These economies actually increased relative trade to both China and to the United States. There is a story out there that this has something to do with trade frictions and geopolitical fragmentation, that trade that previously went directly from China to the United States or the other way is rerouted through third countries, some of them in ASEAN. And in order to test the hypothesis, colleagues of us ran estimations where they compared the exports of products by third countries, of products that are targeted by Chinese or US tariffs, relative to products that are not targeted by these tariffs, and how this has changed over time. So this is kind of a difference in differences approach. And it shows a quite significant impact. So these exports of these targeted products have increased significantly more than exports of non-targeted products. That suggests indeed that there's some rerouting story going on. The trade is rerouted through third countries. There's a bit of a debate how positive it is for these countries. For once, because of course economically that is a costly detour. But also because very often we see that only a part of the supply chain is shifting and not the entire supply chain. It means products are still produced, say 80% in the original country, then shipped on somewhere else. The last 20% are added there, and then this is exported to the original destination country, which means that the country that benefits from the rerouting actually gets very little of the value added that is generated in the production of the export product. Now, these are a couple of charts we added. This is some speculation about what may be the impact of different US trade policies. On the left-hand side, you see an index that is not computed by us, but by the Economist Intelligence Unit, and that shows exposure to US trade policy changes across different dimensions. And you see that quite a few Asian economies, including South Korea, score quite highly on that index. So they would seem relatively vulnerable to changes in US trade policies. The right-hand side shows one of these subcomponents, which is the bilateral trade balance with the United States. And what is maybe interesting to see from this graph is that in 2018, when the Trump administration for the first time imposed tariffs on China and other countries, indeed China had a very large bilateral trade surplus with the United States, other Asian economies far less so. In the past 6 years this has changed, and also many Asian economies have quite sizable bilateral trade surpluses with the United States, which may suggest that this time the focus may be less only on China as it was at the time, but may affect a broader group of countries. Here we look now on how specifically tariffs on China may affect other countries. And of course, the different ways how it could affect it. So if China is targeted by tariffs, again, other countries may pick up some of the exports that previously were produced by China. That would probably affect countries in particular who export similar products to China. So on the left-hand side, we have an export similarity index. On the right-hand side, we have the integration of countries with Chinese supply chains. So these countries would probably suffer in case there are tariffs on China because they're part of the same supply chain. The interesting thing is that the countries who compete with China and who are integrated in a supply chain with China are often the same countries. And that means that overall the impact is probably ambiguous. Okay, a few words on policies, and with that I conclude. First, our bread and butter at the IMF, macroeconomic policies, fiscal and monetary. I think our bottom line is at this juncture in Asia, fiscal policies are probably too loose and monetary policies are too tight. Why are fiscal policies too loose? You see the reason on the left-hand side. Public debt levels greatly increased during and after the COVID pandemic, and they have not really come down since. And there often have been plans to advance fiscal consolidation, but they repeatedly have, the plans have fallen short as they were about to be executed. You see on the right-hand side that also for this year we already expect fiscal consolidation advanced Asia to be postponed another full year compared to what we expected only 6 months ago. In terms of monetary policies, I think our recommendation has been for some time that for many Asian central banks there's room to cut rates. In the first half of the year, many central banks were reluctant to do so, probably out of concern about the external value of their currencies vis-à-vis the US dollar. But sort of with the reassessment about the likely path of Fed policies in the middle of this year, this constraint has really eased. You see on the right-hand side that the US yield curve has shifted downwards, with it also the yield curve for Asian economies, so that really points towards cutting expectations. And on the right-hand side, you see that for quite a few Asian economies, Asian central banks, markets actually expect sizable policy rate cuts in the next 12 months, and that would also be consistent with our recommendation. So there's overall little justification to maintain policy rates at the same level as they were during the height of the COVID inflation, post-COVID inflation, especially given that inflation has retreated so much. Last chart, a couple of additional risks that I can't discuss in detail. On the left-hand side, you see household debt over GDP. That relates to financial stability risk. I think we need to be aware that the impact of monetary tightening during the COVID pandemic is still feeding through balance sheets. We had analysis in the April review that this can take 2 to 3 years. So financial supervisors need to remain watchful. One potential pocket of vulnerability is household debt. In many countries, household debt is quite elevated, even compared to the COVID pandemic. Finally, on the right-hand side, you see an index of climate vulnerability. The message here is clear. Many Asian economies are among the most vulnerable economies to climate change that there are, especially in Southern and Southeast Asia. This has plentiful policy implications. We won't be able to discuss those here, but I think it's important that reflect that as a risk, not only for the medium to long term, but very often also for the short term. I end here. Thank you very much.
Thank you, Dr. Wiegand, for your comprehensive and so provoking the presentation. Dr. Wiegand showed a detailed analysis of Asia's economic outlook, predicting a slight decline in the region's growth rate in 2025 compared to 2024. Sorry. He emphasized Asia's critical role in the global economic trends, as the region contributes around 60% of global growth. However, he also noted the vulnerabilities in Asia's highly trade-dependent economies, particularly in the face of rising protectionism and economic fragmentation. He highlighted that many major risks include weakening global demand, geo-economic fragmentation, and slowing growth in China. Thanks again. Now we'll move on to the Q&A session. Thank you for keeping the time on time. We have around 10 minutes for Q&A session. So if you have any question and comment from the floor, raise your hand and identify yourself and specify who your question is directed to. So, Professor Kang, please.
Thank you very much for your presentation. I'm going to ask a couple of questions to Mr. Wiegand. 2 quick questions. First is, you're talking about changing trade patterns of China. So obviously China's export portion is increasing to the emerging Asias and as well vis-a-vis the 2 advanced economies in US including. And I think, do you think this is kind of symptoms of bypass export to the because of this trade tariffs, whatever, way before Trump administration, and China is preparing for this type of the pressure from US. So it means that China looks the graph shows the China's exports to emerging Asia is increasing, but at the end of the day, that could be end up with US, something like that. The question. Number 2. You're expecting the most central banks try to raise, lowering down the central benchmark rate. But I was told that because of the next year the corporate tax cut as well as tariffs, because of the two main forces, they could probably push the inflation rate higher and higher. So there's a suspicion that Federal Reserve may raise benchmark rate after mid-25. So at the end of the day, then they will pick it up as opposed to the other mainstream expectation. There might be some chances for Federal Reserve to raise the benchmark rate. 2 questions. Thanks.
Please, Dr. Wiegand, would you respond to the question?
This one. Okay, thank you very much. Very good questions, of course. So first on trade patterns in China. So yeah, so what we show is just simple correlations over time. So they don't immediately lend themselves to sort of causality, but certainly the story that China exports partly to emerging economies and these re-export then to the United States is very consistent with the data that we show, and also the data for the ASEAN 10 are consistent with that. So they show increased trade activity with both the United States and China, a very different pattern from China itself, which suggests that this bridge function that some of these economies seem to have for global trade, there seems to be something about it. And I think that's also why we did this extra study where we looked at the targeted and non-targeted products. How much is there to that story? And quite clearly there is something to that story. I think what seems likely to us is that so far this is relatively superficial in a sense that, as I mentioned also during the presentation, we often see that only a small portion of the supply chain is really shifting through these third countries. And the question is that the game in which you will stay going forward in case there are increased trade frictions, or do we at some point see really a significant realignment of entire value chains? And of course, then we would be probably in a different ballgame than we have been in recent years. But I think that's an open question. One should say, of course, that part of these trends are probably also can also be explained by things that do not have to do with trade frictions. So I think it's in a way natural that China exports more to emerging economies because they grow faster than advanced economies. So you would expect that relative trade is increasing, but then you would expect the same to find the same in the ASEAN 10, and you find a very different pattern there, which I think again points to a more nuanced and broader story. And then as for monetary policy in the United States, so I mean, I showed the yield curve for the Federal Reserve. So it's true that it now shows less loosening expectations than it did before the US elections. So apparently the judgment of the market is that the policies of the incoming administration may be mildly inflationary and therefore reduce the speed of monetary policy easing by the Federal Reserve. Markets do not yet project an increase in the federal funds rate. I think that's probably still an outsider view. But of course, we are all guessing about what the new policies of the administration will be, and I think we will probably have more clarity about that in the coming months. I think an interesting question is then the impact on the Federal Reserve is one thing, but the impact on other central banks. So would that be inflationary or deflationary for Asia? And I think that's really impossible to assess before you don't know the precise nature of the measures, and then also what it would mean for monetary policy in Asia. But the bottom line is, yes, there seems to be a visible impact on expectations about policies of the incoming administration that affect inflation and would ultimately affect Federal Reserve policy rates.
Thank you. Any other question? Please, the welcoming, the great questions. Yeah, over there.
안녕하세요. 저 국민이
Hello, I am Kim Yeji from Kookmin Daily, and I would like to ask a question to Dr. Wiegand also. And if you look at the recent government martial law declaration, what impact do you think it will have on the growth of next year, the exchange rate, and also the overall credibility of Korea as an economy?
Yeah, so I expected, of course, this question. And I think I need to ask for some understanding that sort of the degree on which I can comment on this is limited. So at the IMF, we are economists. We don't really comment on political events in countries. Of course, you framed it as sort of what is the financial market effect of these events. There, you know, I think first I do more regional issues in Asia. I'm not really a Korea specialist. For that, we would have a Korea team. They probably would are currently scrambling to try to assess that. But I think it's also very early days, right? It's just this was just a week ago, and the way how that would feed into financial markets and into confidence, I think it's probably too early to make any serious assessment about that. I can tell you at a personal level, I was very surprised when I heard the news last week, as probably everybody was. And for a brief moment, I feared that the conference here may be at risk in my trip to Seoul that I very much look forward to. So I'm glad it didn't come to that. I think at this stage, I would not be able to give you a really considered answer about the impact of these events on the growth outlook and the exchange rate for Korea. So I hope you can forgive me that, but thank you.
Yeah, if you have any other question from the floor, so Dr. Yoon Sang-ah waiting for your question.
It doesn't necessarily the case, but yeah.
Yeah. So, as I prepared one question, it goes to Dr. Yoon. Okay. Among the global downside risk in 2025, which risk do you think pose the greatest challenges to Korean economy, and how do you think those risks will affect Korean economy?
Okay, so I think among those three risks that we mentioned, I think the first two might have a very big impact on South Korea. As Dr. Wiegand mentioned before, I think the effect could be very ambiguous in the end, but if the US government tried to raise the tariffs and if they decide to cut some subsidies to Korean factories which was being built in the United States, then it will have a huge impact on South Korean industries and so on. And also at the same time, if we actually never experienced before the Chinese shock, so if it materialized, then it will have a big impact on South Korea too. I think if both two things will combine together, then it will have a huge impact. But when I say it's very ambiguous, there are two things. First one is that when China got shocked from, if the China has a growth shock, and it will have a negative impact to South Korea. Of course, it's one of the biggest trading partners with each other. And the other thing is that if China's growth shock comes from the United States, and that comes, if they try to put a lot of tariffs on Chinese commodities and they export goods, and then maybe that can give us some time for us to prepare for emergence of Chinese manufacturing industry, because we moved from the cooperation between those two countries and to now we are moving to competition. They produce semiconductors, they produce petrochemical things, and they produce petro products, they produce irons and ships and TVs and televisions and electric cars. They are making everything we make. So we are competing with each other in foreign markets. So if China hit by the shock, then it will have a very ambiguous effect on South Korean economy. But yeah, so that's what I can say.
So thank you for your answer. Yeah, okay. So we are running out of time. So let's stop this first session. If you have additional questions, please feel free to discuss them with the distinguished presenters during the coffee break. So I would like to thank our speakers and the participants for their invaluable contributions to these sessions. Thank you very much. Thank you.
Okay, thank you. This concludes the session 1. We're gonna have a short coffee break for 10 minutes. The next section will begin 3:20.
We can see. No.
Okay, we will start the session 2 with the title of Drivers of the Medium and Long-Term Growth of the Region. The session will be moderated by Dr. Jinil Kim, Professor of Economics at Korea University. I will leave the floor to Professor Kim.
Thank you. So welcome back to the second session, again titled Drivers of the Medium and Long-Term Growth of the Region. As Dr. De Wiegand spoke during the first session, the first session was about the current trends or what would happen in the short run, basically 2025. And he emphasized that we are, or economists are better at, not at the short-term forecast, but at looking at the economic trends behind those numbers. And session 2 is about those trends behind the numbers. So we'll have the 2 presentations and 4 panel discussions. By the way, this is the 14th the event of this conference, and I just asked the vice chair, and they started from a informal chat between Jae-woo Lee and Korean economists 14 years ago. And by the way, I came back to Korea in 2010, so it started in 2011. So I believe I've been to this conference every 2 or 3 years. It was the first time for me to chair the session. And also I looked at the list of the participants from the IMF. Almost always we have 2 participants from the IMF, usually 1 economist and 1 deputy chief at that level. But this is here for sure. I looked at the list of the last several years, and 2 at the senior level for sure. And when I first looked at your name, I heard that there's 1 in the B level, 1 in the A level. But shortly after that, I heard about your promotion. So this is surely have 2 economists, both from the B level. That's the first time in 14 years. So that said something about Korea during the last 14 years, at least up to last week. Okay, so for that one, let's go back to the medium and long-term trends. Okay, so first presenter is Alastair Scott, who will talk about long-run growth and structural transformation in Asia and the Pacific. The floor is yours. 25 minutes.
Thank you very much, Jae-woo, for the very, very nice introduction. I hope I can live up to my promotion billing. I also would like to thank the organizers for arranging this. This is a great opportunity for us on our side to actually get your perspective on what we think about these issues and get feedback, which we do take very seriously. Great opportunity for us. As Janil says, this is an opportunity to look at long-run trends. I'm going to not make this a mystery novel. Our message today is very simple. Structural transformation has played a profound role across the region, and it's going to continue. And the challenge for us, through academia, through policy institutions, is to understand those forces and to prepare for them, because surely more is coming. But let me explain that in more detail. So I begin with just a very simple message. This is well known to all of you. The gains across the region have been transformational and incredibly impressive. So for example, here you see per capita GDP, you see poverty rates, the former increasing incredibly, the latter falling also substantially. So those are great achievements. But as we've heard all through the first session, there are several challenges that the region faces right now. We're also going to hear in detail about demographics. We have the challenges of the moment, and those raise some very simple questions. I think the first of which is, where does the region go from here? And is the kind of growth model that it has had to transform over the past 30, 40 years, a model that can sustain growth and welfare going forward in such a way. So, to look forward, first we have to look back. So I'm just going to take a look at some of the facts about the drivers of growth and structural transformation, make a few speculative remarks about what is behind them, and then we can look forward. First of all, we do some analysis in the paper attached to the Regional Economic Outlook that was published in November. The basic growth accounting tells a story that in advanced economies, growth has very much been a story of human capital development and TFP growth. In emerging and low-income countries, a very strong role for capital accumulation. Across the region, labor dynamics have played a substantial role. In advanced economies on the right, that's much more about the increase in labor participation. In the emerging markets and low-income countries, very much a story about the demographic dividend, just the sheer number of people available to work. But we also, as we're going to just hear from in the second presentation in more detail, demographic pressures are making themselves felt. We have several countries on the left-hand figure, in the top left there, you know very well, where population growth rate is slowing, working age population growth rate is that is going to come down, and dependency rates are going to increase. But even in those countries on the right, the populations are going to grow older, so dependency ratios are going to increase, and we still think that for countries where populations grow older, there tends to be an association with lower productivity rates. So even for those countries where change in working age population is not so pressing, there are still issues to consider with demographics. We do some exercises in the chapter to put that together, and although we can argue here and there about how much quantitatively the effects are going to play out, whichever way we cut it, doing a number of different scenarios, the message seems fairly clear. Trend growth rates will decline based on these demographic pressures unless something else happens. And of course, that's where we have to look at productivity. So, when we think about productivity, this is where structural transformation comes in. This figure shows the decomposition of labor productivity growth for the advanced economies in the region, emerging market economies in low-income countries. And we see that we decompose it into two types of growth. There's the labor productivity growth that comes from doing a better job at what you're already doing. And then there's the labor productivity growth that comes from actually switching to doing something else. And that's this process of structural transformation that we want to emphasize. And as you can see, this has played a very significant role in increasing labor productivity, particularly in emerging markets and low-income countries in the region. So what does that amount to? Well, structural transformation is a process of moving resources away from one sector to another. And the canonical depiction of structural transformation, going back to the work of Simon Kuznets and others 60 plus years ago, is that countries tend to move from being basically agricultural, they move into light industry, they develop heavy industry, and then they can move more into services. Generally speaking, this is held within the region, and a very substantial transformation away from agriculture towards manufacturing and services. This has very much, what you see on the right-hand side, been a story of the emerging market and low-income countries. So that has generally been true across the region. But as I'm about to talk about, there are several nuances that are important to bear in mind. So as economies have moved away from agriculture, in the region they've generally become heavily industrialized, and in fact more so than other countries in the rest of the world for the same stage of national income. This is very much a story about a very, very rapid shift towards industrialization. So we can see that by actually plotting observations. What you see here is observations in gray for the rest of the world for a whole sample of, I think, 74 countries, where what we're doing here is each dot represents a year for a country plotted against the national income of that year and the share of industry in the economy. So the red dots here are just showing the Asia-Pacific countries in 1990. Then we see 2004 and 2018. So you can see how Asia-Pacific economies have gone through this cycle away from agriculture towards more industry. You can see that there are several there that are well above the fitted curve for the whole sample, more heavily industrialized than normal. You can also see when we identify individual countries that there are some that are already at the stage of the fitted curve where industrialization is receding, or that industrialization was never so intense in the first place. And then it raises questions for that cluster in the middle with countries that are very heavily industrialized right now. Is that going to stay this way, or are they too going to deindustrialize, and what potentially does that mean? So one factor that we've been looking at very closely for this work is the role of trade. And it's very clear that when you look at the role of trade, how it has been very intimately linked to facilitate the role of industrialization. And basically this is the macroeconomics that we were taught as undergraduates at work. Opening markets to trade has allowed economies to access demand far bigger than they could have done had they stayed marketing only to their own populations in their own economy. So this has been a transformational story. But this is where the kinds of issues that we were speaking about in the earlier session come to play, because trade openness, although it rapidly increased through the 90s and early part of the millennium, has actually stalled since the global financial crisis, measured here in terms of imports and exports. And also the progress on reducing tariff rates has also slowed. But we see this close association, so it's worthwhile bearing that in mind as we talk about how things might move forward. With the rise in industrialization, I said before, more than usual for other countries at the same level of income, the flip side also applies. Asia-Pacific economies are generally lower in services for the same stage of income and is generally typical. However, that does not mean that services are unimportant. In fact, when we trace the numbers of people moving out of agriculture into other sectors, and this actually really surprised us, there's been more employment already generated in services than there has been in manufacturing through this 30-year period that we're looking at. And that's worth bearing in mind. Now, as we look forward, let's put these things together. The first thing we look at is, well, what are the prospects for growth and the labor productivity growth that I mentioned before? What you see here on the left-hand side is just a static analysis that looks at productivity gaps. And the way to read this figure is, if you're down to the lower left of each quadrant, whether agriculture or manufacturing, those economies are very close to a global frontier of high productivity. And we see that the Asia-Pacific economies have some economies in those positions. If you are to the left and above the black line, it means that there is a productivity gap to the frontier. And we divide that into the samples of the gap in the beginning of the sample, 1990, and the end of the sample, 2018. And what we're seeing is that the agricultural gap in productivity for most countries across Asia-Pacific is actually quite substantial. So agricultural productivity is still being a drag on structural transformation. You actually want more labor productivity in agriculture to be able to release people from the land so that they can go and do something else that's more productive. But that isn't happening for many countries still. In manufacturing, the story is that actually there hasn't been that much progress in increase in manufacturing productivity. There are some countries that are very close to the frontier, but for those that aren't, that gap hasn't changed very much. In fact, what it implies is that mechanically, just shifting more of the workforce into manufacturing would not raise average productivity very much. So, where does that leave us with services? Does that mean that services could be the future? We have to be quite careful here. What I'm going to talk about is very much about overall forces. There are very significant factors for each country going on. So the country-specific context is very important to bear in mind. But I'm going to talk at this 100,000-foot level of generalization. We've already mentioned that the agriculture gap is quite high generally, so there is potential to release more people out of agriculture into manufacturing and services. When we look at the breakdown in services, one message I think that's very important is that services is in fact very heterogeneous. I think there's a bias in our field that we think of services as not very productive. It's probably because as undergraduates we were told to think of non-tradables and tradables, right, where non-tradables was cutting somebody's hair, and we think of that as the key service, or making beds in a hotel. The technology, the production function for making beds hasn't changed in several hundred years. But actually services includes modern services and very tradable services like IT, business processing. So what we see here is actually that the labor productivity in those modern services is actually well above that of manufacturing. So that's a kind of cross-sectional or static analysis. We also, in our note, go on to do a dynamic analysis of beta convergence and sigma convergence. So what you show here is the coefficients in a beta convergence regression. Where they're shaded in dark, it shows that they're significant. So the significant boost in convergence to overall productivity across the whole sample, again, I stress that this is very, in the details per country, it's context dependent, is very much in the modern services, business, finance, leading the way. And actually that the other sectors, including manufacturing, do not show up as significant in convergence. This is quite a surprising finding. It's actually one that contradicts some prominent papers of a dozen or so years ago. But it's one that we've looked at very, very closely and we think holds up robustly. But how could that play out in practice? Well, one issue, coming back to trade, these modern services tend to rely on being tradable. They still need the exposure to a large market for them to succeed. The share of modern services in exports across the region is actually quite low compared to the rest of the world, or at least advanced economies. One reason that we think one factor that we think might be playing a role is that although trade restrictiveness in manufacturing has come down substantially and is generally below the global average, services sectors are often quite tightly restricted from competition in the rest of the world. And that would be something to look at in general. So, to give some conclusions, this is a very high-level analysis. As I've tried to emphasize, country context really matters. In fact, when you look at the convergence regressions, we don't find that evidence of unconditional convergence driven by manufacturing. We do find conditional convergence from manufacturing, but that's basically saying that for some countries there's some unknown secret source that makes them successful in manufacturing. And it's very hard to generalize. But to draw back on some broad conclusions, across the region, like many others, demographics are going to pose a pressure to growth. That seems fairly clear. So it's going to rely on improving labor productivity, among other things. Agricultural productivity can improve, certainly, but the relocations towards more productive services would be more likely to set the conditions for growth. The policies to do so are complex and require a lot of a more detailed discussion. But it does, in many ways, come back to the basics of enhancing human capital, which means training, and particularly to facilitate the transition away, if this is going to happen. If people are going to move from agriculture and move from manufacturing, governments have a role to play in terms of preparing businesses and workers for that transition to make sure that people are not left behind. So I think we're in a position where we're going to see a lot more structural transformation, and so we need to understand it. Thank you.
Thanks, Alastair. So he emphasized several aspects of structural transformation and also at the end talked about country context. So next presenter is Professor Jong Seok-hat and Dongguk University, who will give a Korean context in the demographic changes and their economic prospects. Okay, thank you. You have 25 minutes.
Okay, hello everyone. I'm Jong Seok-han from Dongguk University. It's a great honor to be here today and give the last presentation of today's wonderful conference. Before I begin, I'd like to thanks to President Lee Si-wook and Vice President An Sung-bae of the KIEP for inviting me to speak at this wonderful KIEP and IMF joint conference. I also extended my appreciation to the Dr. Yoon Sang-ha and all the dedicated staff members who worked tirelessly to organize this remarkable conference. In the preceding session, Dr. Scott provided the valuable insight into the drivers of the long-term growth in Asian countries. He highlighted emerging challenges and proposed the policy direction for ensuring the continued growth in the region. Building on this discussion, my presentation will be focused especially on the long-term growth in Korea. As the Dr. Scott emphasized, the demographic pressure are expected to be a significant factor constraining the future growth. Given the profound demographic change Korea has been experienced in the recent years, I'll discuss these changes in detail and examine their economic implications. So let's start with some motivation here. So this graph shows the population growth across several countries. The red line is going to be the Korea. The blue line, the dashed blue line is going to be the Japan, and the black line is the average of the world, and the gray line is the Asian country. As you can see here, in 1970, the Korean population growth was around like a 2.1%, but it suddenly dropped all the way down to the negative in 2023. And this decline is remarkable compared to any other countries in the world, especially when you even compare to the Japan, the difference is much larger than the Japan. And now we can break into in order to understand what's going on here, we have the total fertility rate in the left side and the life expectancy on the right side. So the total fertility rate in 1970s in Korea, it was like a 4.5. It all the way dropped to the 0.07. And when you compare to the number in the world average, 2.25, so it's going to be really lower compared to the world average here. But the life expectancy has been grown up pretty far. It starts from the 62, and 2023 we have like a 84.3. So due to this dramatic change in the total fertility and life expectancy, the age structure in Korea is going to be changed a lot. So when you look at the dependency ratio, the left side is going to be the old dependency ratio. So it's going to be capturing the size of the above the 65 age. And the right panel is going to be the dependency ratio for the young. As you can see here, the Japan has all the dependency ratio has been dramatically increased. And also the Korea also experiencing the very rapid increase in the old dependency ratio. But when you go to the young dependency ratio, the Korea is experienced the most dramatic fall down for the last 55 decades so here. So this is going to be the one, kind of the rapid demographic structure that the Korea is facing right now. So based on this motivation, so I'm going to show the actual population trend in Korea more details. And also, I'm going to move on to the population projection. It's going to be the official population projection by the Statistic Office. And I'm going to show that under the simple analysis, I can show that what is going to be the main driving force in the demographic change in Korea. And before I move on to the impact of the demographic changes on the economy, I'm going to just briefly go over how the economic outlook, economics was looking like in Korea. And then I'm going to use some the production function methods to do the output projection based on the different population projection. And the later part of this analysis, what I'm going to show is, in order to mitigate the impact of the demographic change, how can we, the amount of the labor force or the employment rate should be adjusted in several different scenarios. And I'm going to show that how much the employment needs to go up to reduce the negative impact of the demographic change on the economic outputs. And lastly, I'm going to discuss about some policy response that currently discussed in the Korean economy. Okay, so this is the past data. So left side, we have the population level. And as you can see here, the total number of the population in 1970 was like 32.2 million. And in 2022, it went all the way up to the 51.7 million. But when you look at the age structure, you'll see that more than the 95% in the 1970 was below 65 years. And only above the 65 years old, only like the share is going to be only about like 3%. But now when you look at the share, you'll see that the share of the old population went up very high. And at the same time, the young, who's below the 15 years, has been dramatically falling down. And the total fertility rate here in 1970 it was like a 4.5, but it went all the way down to the 0.7. But at the same time, the life expectancy has been gone up. So these two factors is going to be designing the population structure change. The interesting thing is on the right side of the panel. So as you can see here, the black line is going to be the population growth rate, and the red line is going to be the birth rate, and the blue line is going to be the death rate. The population growth rate has been falling down, but the similar trend is only showing up in the birth rate, and the death rate, it didn't change much. So most of the population growth rate seems to be determined by the birth rate here. So, and now we are going to move on to the official population projection in the Korean government. So Statistical Office provides the population projection in Korea for every 5 years. So I have the number for the 2015 and 2020. And because there was a dramatic demographic change between the 2015 and 2020, the Statistical Office provides a special projection in the 2017. And because of that, they also provide a special projection on 2022. So these graphs are showing that the different projection the projections of, at the different years. So red line is the most recent one, the projection from the 2022. And as you can see here, the highest one with the gray line is 2015 projection. So the population growth in 2015, we didn't expect that it's going to be turned into the negative until 2033. But the most recent population projection tells us that already in 2025, the population growth is going to be turned down to the negative. So there's going to be the huge difference between the projections here. And also, the total fertility rate and the life expectancy and birth rate and death rate are provided here. As you can see here, the total fertility rate or the birth rate, you'll see the large difference across the different times of the projection, but life expectancy or the death rate is going to be pretty much stable across the projection. So From here, what you can already know that is the population change in Korea is mostly driven by the birth rate or the total fertility rate, not from the life expectancy or the death rate. Okay, so in order to show that, what I'm doing here is based on the 2020 projection, I'm going to change the birth rate or the death rate based on the different times of the projection here. So the blue line here is going to be the population projection from the 2022, but the red line here is I'm gonna maintain the death rate, but I'm gonna just switch the birth rate from the 2015 projection. So as you can see here, if you have the 2015 projection, the birth rate projection, the population growth rate is gonna be dramatically going up compared to the recent population growth projection here, and the level of the population will show up in the right side too. But when you do the similar exercise, instead of using the birth rate, you're gonna having the death rate, what you can see here is there's gonna be not much difference in the population growth rate here. So overall, all the population growth in Korea is mainly driven by the birth rate, so it's gonna be more important to focus on the birth rate, how the birth rate and increase the total fertility rate in terms of the policy. Now, before I go on to the future projection of the output, I'm going to just briefly go over the economic features in Korea. So some of the macro variables are in the left panel. So output is red, and actually the blue line is going to be the labor, that the number of the labors that use in the production. As you can see here, recently the Korean economic growth has been fall down around like a 2%. And the most of the growth rate growth is driven by the capital in the past, but nowadays it's going to be falling. All the factors are going to be falling down. And when you go to the employment rate in the right-hand side, we have the overall employment rate has been steadily increased from 2000 to 2023. But as you can see here, the red line is the female employment rate. The most of the increase in the employment rate is driven by this female employment rate. The male employment rate was pretty stable over the last 2 decades. Okay, so the labor force participation by the age, you can see there's going to be the big difference between the male and the female. Also, the shape is going to be different. And as you can see for the female cases, well known as the M-shaped curve, labor force participation M-shaped curve here. So this M shape is actually driven by the combination about the employment, labor force participation for the unmarried woman and the married woman. So the dip is going to be coming through the lower labor force participation rate from the married woman. So this is going to be the key feature that we have to have in mind when you do the projection here. So in terms of the methodology, this is going to be the very typical way to use. You can do the projection for the output. This is going to be just using the Cobb-Douglas projection function and using the factors to do this. And this is kind of the very conventional stuff. So I'm not going to go into the detail. But there's going to be some assumption that I'm going to using here for the capital. The saving rate is I'm going to just using as the average, which is going to be the 30%. Total factor productivity growth rate is 1.5, and the human capital, there's going to be some projection by the Han and Lim, which I had the paper before. And the labor here, that I'm going to use the number of the population from the population projection, but the employment rate is going to be fixed across the time. And it's going to be fixed at the 60.5%. And so here's the output projection that I used the 2022 population projection here. The output growth rate has been declining, but as you can see, the red line is the output growth rate. It's going to be declining, but as you can see here, the blue line, which is going to be the labor, and mainly driven by the number of the population growth rate. Due to this negative population growth rate, you'll see that output growth rate has been going to be falling down. And here, what I'm going to do is I'm going to having a output projection based on the 2020 population projection and compared to the 2015 population projection. So as you can see before, 2015 population growth was higher than the 2022. So that comes up in the left panel of the output growth rate. You'll see the blue line, which is based on the 2015 projection, is be slightly higher relative to the 2022 projection. So at the end, in the 2070, we'll see that the output difference is going to be quite substantial across the two different projections here. Okay. Now, I'm going to do some simple exercise here in order to mitigate the negative impact of the population, how much the employment should be adjusted for the several different scenarios here. The first one here, to maintain the 2015 projection, the population projection, I was backing out how the employment rate should be maintained. So this graph shows that in the 2020, we start from the 60% of the overall employment rate, which is going to be the blue line. And in order to get rid of all the negative impact between the 2022 and 2015 projection, the employment has to go up to the like a 67.4 until like 2070. And if you are kind of mitigate this negative impact only through the female employment rate, the female employment is going to be like a 51% in the 2022, but it has to be all the way gone up to the 63% at the 2070. So annually, for the female employment rate, we need like a 0.3% point annual increase for the female employment rate. And this one is, what I'm going to show here is to offsetting the negative growth of the labor force, which is coming through the population growth, what is going to be the employment rate we should meet here. The red line is the offsetting the negative population growth rate. So the employment rate should raise up from 60% in 2022 all the way up to the 84%. And once we mitigate, offset this all negative impact of the population growth, then you'll see the output growth rate, the red line in the left panel, you'll see the output growth rate is maintained around like a 1.5% growth rate annually here. So if you can deal with this negative population impact, then you can have a substantial amount of the output growth gain here. Okay, so the last part of this presentation is about the policy response. Then, how can we improve the employment rate? There's going to be the three ways that the employment can be raised, and there's actually the government is doing some of the policy response relating to this three part. The first one here is increasing the female labor force. The second one here is increasing the elderly labor force. The third one here is using the foreign labor force here. So in terms of the female labor force, as you already saw a similar picture in the previously, but here what I'm going to show is I'm going to compare the Korea, Japan, and OECD average life cycle labor force participation for male and female. As you can see here, the Korea's female labor force participation is way lower than the average of the OECD. There's a lot of room to improve in the female labor force, so that's going to be the first response to the policy reaction here. But the problem is, it's going to be better to focus on the married woman labor force participation, not the unmarried woman. The second policy is related to the elderly labor force participation. So there's going to be a discussion about raising the legal retirement age to bring the elderly labor force into the market. But here, when you look at the 65 and 99 age, the Korea's elderly labor force participation is already higher, very much higher than the OECD average or even for the Japan. So I'm kind of doubt that there's not much room to improve the elderly labor force participation in this area. And also, the Korea has some of the policy that it's going to be to mitigate the high elderly labor force supply. There are some policies that providing some cash transfer to the elderly person to mitigate this high elderly labor supply. So there's going to be some policy conflict in terms of using this elderly labor supply here. The last one is the foreign labor supply. So if you want to offset the negative impact of the population growth, what you have to do is there's another option that you can bring some foreign labor force from outside of the Korea. And there's going to be the two-way. The first one is using the temporary worker, which is related to the limited employment visa. And also you can have the permanent residence through the immigration. My point is the temporary foreign labor force is going to be benefit for the old age population dependency ratio. So it's going to be help to mitigate the negative impact of the population. But when we have the permanent immigration, it might not have a huge benefit to reducing the old age dependency ratio. So it's not going to be like working as we expect. So for the conclusion, so here we saw that there's a huge, a rapid demographic change in Korea, and the negative impact of this population growth on the economy is substantial. So if we want to reduce this negative impact, that the one way is to try to improve the labor force in the market. There's going to be the 3 different ways that the Korean government are doing it, but my personal viewpoint, increasing the female labor force participation might be the most valuable way in terms of the policy reaction to the negative population growth here. Thank you very much.
Thank you. Okay, thank you, Professor Han, for a very timely and needed discussion for Korea. Okay, so we'll have 4 discussions. It's written in the Korean alphabet way, but let me switch the ordering a little bit so that because each person will discuss a different convex combination of the 2 papers. So first, I'd like to invite Dr. Johannes Wiegand, Chief of the IMF, who will discuss mostly on Professor Han's paper. 10 minutes.
Thank you very much. I'm not certain the microphone seems to be working okay. So this was a very interesting, very comprehensive discussion. So I really don't have anything to contribute on Korea. I think where I can contribute a little bit is sort of the Asian perspective. This is the first part of my remarks. Here you see on the right-hand side a chart which is very similar to what Alistair showed in his presentation, except it doesn't show the projected increase in the old age dependency ratio, but the existing old age dependency ratio on the y-axis. And you see that so quite a few countries in Asia are struggling with similar issues as Korea. It includes, of course, Japan, where aging is actually much more advanced compared to China already. But interestingly, it, for example, also includes China, which has a massive aging issue which will very significantly affect potential growth in the coming years. The interesting hypothesis in China why that is, some people say it has something to do with the one-child policy. So first the government introduced the one-child policy because it didn't want to have the population to grow so fast, and then it became sort of a success that you can't undo because as a result, people invested so much into their children, into the one child that they have, that now it's too expensive to have a second child. And even if you unwind the one-child policy, people wouldn't have a second child. Be it as it may, I think what the left-hand chart shows in the sort of right portion of the panel, that groups countries in Asia by countries that are old. These are the same countries which in the right-hand side picture are on the left-hand side. So the Koreas and Thailands and Hong Kongs and Japans. And countries that are young, which are all the other countries on the right-hand side. And you see that for countries that are old, we really would have to expect that demographics will reduce growth going forward. And that's a turnaround to the traditional story, where most countries had demographic tailwinds for growth from demographics, and now they will turn into headwinds. Which raises, of course, the questions what you do about it, and I think the professor outlines also the policies very comprehensively, so I don't have very much to add. My second contribution is maybe, this reminds me very much of the discussion in my own country, in Germany, which is also struggling with the aging issues for a long time. Very often depends on sort of what is the political context for that in Germany. A lot is about the sustainability of the public pension system. and how that would survive a rapidly aging population. It has massive budgetary implications. For example, in Germany, 1/3 of the federal budget by now is spent on subsidies for the public pension system, which also makes budgets very inflexible and very difficult to adjust, because so much sort of is entitlement spending, which is very hard to modify. So I don't know exactly what is sort of the political connotation in which this is being discussed in Germany. In Korea, in Germany, it is a very strong fiscal and pension connotation. I found very interesting the remarks about increasing labor supply. So the same issues are discussed in my own country as well. And I think it very often shows how much the tax and benefit system and the incentives that these systems set matter for labor supply. In Germany, we have also very low female labor market participation compared to other European countries. And people very often quote two things for that. The one thing is that in Germany, school ends at 1 p.m. So when I went to school, it started at 8 in the morning. I came home at 1 p.m. And afterwards, somebody needs to look after the children to do homework, right? And this is a very strong negative incentives for mothers to seek work, and continues to be. The second big thing in Germany is taxation, which seems very technical, but has a massive impact. In Germany, household income is taxed jointly. So you add up the income of the spouses, and you divide it by 2, and you tax then the average income of the spouse. Since the tax system is progressive, it means the greatest tax advantage you get is if one person works full-time and earns a lot of money and the other person doesn't work at all. Because then you sort of fall into the middle range and you're well below the progressivity line. There have been countless proposals to switch that in Germany to individual taxation, which would remove the negative incentives for spouses to seek labor, but it seems a reform that's almost impossible to get through the political system, even though it is blatantly evident what negative impacts it has. Now, I don't know whether income is taxed individually or on a household basis in Korea, but it's often policy parameters which seem fairly technical, but that create these negative outcomes in terms of labor market integration, which in turn has negative repercussions for the sustainability of public pension systems and for the impact of aging on growth and productivity. I think these are the comments I wanted to make to maybe complement to the debate, but thank you very much.
Okay, thank you. Okay, so our second discussant is Dr. Sun Young-jeon. She's a senior economist in the macroeconomic analysis team in the research department of the Bank of Korea. Okay, so you have 10 minutes.
And good afternoon. My name is Sun Young-jeon, and I'm from the research department at the Bank of Korea. Today, I'm honored to discuss the two very interesting papers presented by Dr. Scott and Professor Han in this session. Before we begin, I'd like to note that all the views expressed in this presentation are my own as the discussant and do not reflect the official stance of the Bank of Korea. And I'll skip the summary of the papers and I proceed directly to my main comments. And Dr. Scott highlighted emerging challenges faced by Asia-Pacific region, such as demographic changes like population aging, trade stagnation, and slowing productivity growth. These challenges are like invisible gravitational forces holding back economic growth. Similarly, these factors are also constraining growth in Korea. With this in mind, I'd like to discuss the current state of the Korean economy in relation to these challenges. The first challenge is the rapid demographic transformation. It is well known that Korea is aging at a faster pace compared to other countries. But it is not only that, it's getting faster. The year 2020 marked a pivotal moment as it was the onset of the pandemic, as it was not only the onset of the pandemic, but also the time when changes in the population structure sped up. Over 8 million baby boomers started to enter the 65 and age group. And Korea's population began to decline in 2021. This combination of a growing elderly population and a shrinking total population has significantly accelerated the rate of aging, effectively doubling its speed. In addition to aging, another key demographic shift in Korea is the growing number of unmarried individuals. This rise in singlehood is expected to bring about long-term structural changes in consumption and savings behaviors, labor market dynamics, demographic trends, and welfare systems. Looking at the Korean labor market, we can foresee significant changes in female labor force participation. This is largely because in Korea, female participation in the labor market clearly differs between those who are married and those who are single. This is illustrated by the so-called M-shaped curve, where employment rates for women decline during marriage and child-caring years. Married women generally have lower participation in the labor market compared to single women. Their employment rate is 18 percentage points lower. They work fewer hours on average, and a larger share are employed in low productivity or part-time roles. These clear differences in labor supply patterns by marital status suggest that as the share of single women increases, the labor market impact of female participation could develop in ways that differ from past trends. I think that these aspects of demographic changes are very important, but may not have been fully considered in the existing literature. The second challenge is the structural transformation of production and trade patterns. The Korean economy has strong ties to global value chains. Starting in the 2000s, Korea actively utilized global value chains to strengthen its production structure with a particular focus on its linkages with China. However, according to research findings of our team, the growth of Korea's GVC-related production has gradually slowed since the 2010s. This is largely because the key factors behind these changes are closely linked to China. The relocation of production bases to countries like Thailand and Vietnam has weakened Korea-China linkages. At the same time, China's technological advancements have shifted its role from relying on Korea to becoming an intermediate provider. These changes initially appeared in low-tech sectors and have gradually spread to high-tech sectors. Even the IT manufacturing sector has experienced a sharp decline in its linkages with China since 2018. These shifts in GVC-related production structures are likely to have a significant impact on Korea's future economic growth path. The third challenge lies in the manufacturing-centric inertia of Korean economy. The pandemic has accelerated the shift toward a digital economy. Digital technologies enable the servitization of physical products and the cross-border trade of services. Now, services are accounting for an increasingly larger share of global trade. In this context, the integration of services and manufacturing technologies has become a key driver of productivity growth. However, Korea's economic structure has not fully adapted to these challenges. While manufacturing has long been the backbone of the Korean economy, but this has resulted in a rigid separation between manufacturing and services. Moreover, the service sector is often still perceived as primarily domestic or non-tradable, limiting the global expansion of competitive service sectors and keeping them confined to the domestic market. Korea's R&D investment has been heavily focused on manufacturing, especially in electronics and automobiles. At the same time, the development of intermediate services has been relatively limited, resulting in weaker service exports compared to other leading manufacturing countries. Meanwhile, China, global manufacturing powerhouse, has been actively supporting the integration of digital and traditional technologies since the 2010s. As a result, it has recently surpassed the United States in the scale of digitally delivered ICT service exports. To maintain Korea's manufacturing competitiveness and strengthen its position in global trade, it is essential to move beyond the dichotomy between manufacturing and services, and to enhance the convergence between the technologies of the two sectors. And I'd like to wrap up a discussion here. The challenges faced by Asia-Pacific region and Korea are fundamentally similar, differing just in their timing and intensity. We are now undergoing a period of transformation where labor, capital, technology, and even the production function are simultaneously evolving in fundamental ways. To turn these challenges into opportunities, Korea needs to shift toward a new direction that reflects the structural changes now we are experiencing and those we are likely to face in the near future. In this regard, I believe the research findings and insights shared at today's conference will provide valuable guidance for reshaping forward-looking policies for Korea. Once again, thank you for your attention.
Thank you. Thanks, Dr. Jung, for an excellent discussion. Yeah, I remember that the president of KIEP in the opening remark also mentioned how to change the challenges into the opportunities, and then Dr. Jung followed that and then she gave us some concrete comments. Okay, our third discussant is Professor Sang-min from Kyung-hee University.
Good afternoon, everyone. I'm Sang-min from Kyung-hee University. Today I will discuss two important presentations, one by Dr. Scott and one by Professor Han, both of which explore critical factors driving long-term economic growth. So the presentation by Dr. Scott highlights structural transformation's role in long-term economic growth. And a key trend here is the kind of moving from manufacturing to services, the rise of services. The researcher says that the structural change can be driven by two things. The firstly, by rising income that increases the demand for services goods. And secondly, by faster manufacturing productivity growth, pushing employment out from manufacturing into services, which often referred to as Boehmer's cost disease. Given that the productivity differential across sectors is an important driver of the structural transformation, it's important to ask whether the historical trend of rapid manufacturing productivity growth would continue. The thing is that the presentation by Dr. Scott raises the question that the services might be the one that has high potential growth. And then we may think that whether these changes in the productivity would affect our predictions on the magnitude and the direction of the structural changes in the near future. And also I'd like to address how the heterogeneity within the services can have different implications on the economic growth. We know that the technological change plays a critical role in sectoral productivity growth. As shown in the first figure, the most low, the exponential growth of transistor counts has slowed recently. It's not that conclusive yet, but we see a little bit of slowdown in recent trend. That suggests a potential limits to hardware-driven improvements. And the right panel shows the shift in investment. We see the declining share of industrial equipment and the rising share of software. Most low and equipment investments supported routine task productivity, which is concentrated in manufacturing. The thing is that the software, on the other hand, supports a broader range of tasks, including the ones in the services sector. So this marks a potential shift from manufacturing-focused improvements. We can see it a little bit more directly through the occupational exposure of different technologies. In these figures, the horizontal axis is a skill percentile, meaning that each point in the x-axis is a group of occupations having 1% of employment sorted by their wage. So from the lowest paying jobs all the way to the highest paying jobs. We see that the equipment and robots are heavily used in middle-skill jobs who works mostly in manufacturing. On the other hand, we see that software and AI have a greater exposure to high-skill jobs, many of which work in services sector. This again marks a potential shift from manufacturing, productivity dynamics from manufacturing to services. They can have important implications on the direction and the magnitude of structural transformation in the near future. Services, as IMF, the Dr. Scott's presentation highlights, are highly heterogeneous. So there are producer services which are tradable and have high productivity potential, and consumer services which are local and non-tradable. It seems that the IMF REO Regional Economic Outlook highlights producer services for their rapid productivity growth potential, as it's more related to the recent innovation and rising tradability. The thing is that consumer services may remain important as well. Although it can be less influential on economic growth, it may have a significant impact in terms of welfare, as recent literature highlights. Moreover, in Korea, consumer services employ a growing share of, actually the largest and the growing share of the workforce, but have lower productivity compared to other countries. So I believe that the targeted policies are needed to balance growth and welfare across diverse services. When it comes to demographic, both IMF and Professor Han suggest demographic changes as a major challenge for long-run growth. In particular, Han highlights that rapid aging of population presents significant risks to labor supply. If I understood correctly, Professor Han mostly focused on the quantity of labor, while it has a human capital, but it's basically the years of average schooling. But the thing is that the demographic structure itself has a significant impact on labor quality, as the workers of different ages have very different productivity. So the question arises, how the productivity differences by age affects long-run growth? In Korea, we see that the share of individuals of age 40s, which are assumed to have a peak productivity based on their wages, has been declining since the early 2010. Because the age of 40s has the highest productivity highest paying, they basically have highest average wage, so that if they have highest productivity, then the increases in the 40s would contribute positively to the labor quality, and the decline would reduce the labor quality. And we can see in the right panel that actually the declining in the share of age 40s aligns with the slowdown in the labor quality in Korea. The thing is that the seniority-based wages in Korea may further amplify this challenge. Seniority-based wages is relatively more pervasive in Korea, or Japan. And under this system, as workers age, wages often exceed the productivity, widening the wage productivity gap. This disconnect between wage and productivity implies that the labor quality declines due to demographic change would be more severe than wage-based estimates suggest. Therefore, addressing these challenges requires not only increasing all the workers' participation, but also improving their productivity. The challenge is that currently workers in Korea retire early from primary jobs, on average at age of 49, and transition mostly to low-skill jobs. I believe that extending tenure in primary jobs can be a promising solution, especially as older workers become increasingly skilled, as figure in the right shows. However, given the influence of seniority-based wages, we need a very careful design for this kind of policy to ensure sustainability or effectiveness of such policy. Okay, thank you for your attention, and I look forward to further discussion on these important topics.
Thank you. Okay, thanks, Professor Ahn. So our last discussion is Dr. Song Bae-an, who is the Vice President for the KIEP. Okay, so the floor is yours.
Okay, it's an honor to have an opportunity to discuss all these two interesting papers. And here, well, I tried to put some title on my discussion, but somehow it is very hard to come up with a good title. So anyway, I will try to say something about, say, service trade. Well, at the end of the day, because one of our things that Korea, well, this economy faces is that now we have the fierce competition from China. So most of our, say, manufacturing, well, in the long run, I should say, well, is somehow affected, well, and maybe, well, some competitiveness may not be that, well, sustainable in the long time. So anyway, this is three industries, the agriculture and manufacturing and the service industries. And on the left-hand side, you have, say, the composition, well, by GDP, according to the GDP, value-added value. So what you can see here is that, well, over last, well, about, yeah, from 80s, so it's about 45 years, so well, the manufacturing share, well, doesn't really change much over this period of time. And while the agricultural share drops and their service share, well, increases a bit. On the right-hand side, the timeline is much shorter, well, from 2013 and 22. And while this is a composition according to the employment share. So, well, surprisingly, well, there's basically no changes in the composition of by employment. So that means that somehow what this while the service relative productivity of the service sector is actually drops while comparing to the manufacturing sector and the agricultural sector. So this is taken from Dr. Scott's paper, and there on the left-hand side we have the manufacturing sector. On the right-hand side we have the service sector. When I just try to find where the Korea is located, so the first graph shows where Korea is located. So this is somewhere. So Korea is above the curve, and somehow the manufacturing sector share is above compared to other Asian economies. Well, it is much higher. But on the right-hand side, this is the service sector share. So it is kind of following the trend. Well, I mean following the other Asian economies, right? So somehow, maybe there is some things we can be better off or whatever. So by increasing the service sector, the share in some sense. So this growth, Korea's growth, has been, derived by the manufacturing sectors, and now, and especially is supported by exports and outward FDI. So on the left-hand side, we have, this bar graph is the exports from national account, and there, this one you can see here is that, even though, the exports to GDP ratio has, one thing is that, exports to GDP ratio has been slowed down, after, global financial crisis. But, interestingly, among the exports, service exports, the ratio does not really change much. So it means that, somehow the growth of goods exports and the growth of the service exports hand in hand together, for last couple of years, last 20 years. Okay. On the right-hand side, now what you can see here is that. So this is from IIP, international investment position. So this is outstanding FDI across different regions, and what you can see here is that China's the FDI into outstanding FDI into China has been a little bit increasing, but not much. But recently, FDI to U.S. increased a lot, and also Southeast Asia. So when you look at this from the more micro data, so this is the comparing 2018 and 2022. This is the overseas subsidiaries of firms' behavior. So basically, firms' behavior. Who has a the subsidiary in USA? Then over just 5 years, the purchases increased a lot. Means that basically, from the result of the increase in FDI to that region. And one more interesting part is that I think this is still a little bit the early stage of the FDI into the U.S. But anyways, the exports from Korea to the States following this FDI takes up about quite the big composition, so about 60%, more than 60%. While this FDI to the China, so basically the intermediate goods export to support this FDI is around 30%, and the ASEAN is a little bit higher. Okay. So, the manufacturing has been successful until this part, but what we can do to increase the service sector productivity? This is a little bit difficult question. This is everybody says that this is the way we go, and as Professor said, that service sector is very diverse, and so we may need to look at a little bit more on this service sector, especially trade in this context. Okay, so there is a call that service sector exports can be classified into 4 categories, 4 modes. So mode 1 is that basically the cross-border supplies, where you just send the services over 2 countries cross-border, but other things does not move. So especially the person and the capital does not move across the country over here. And mode 2 trade is that consumption abroad. So person from country A visit the country B and do the consumption there. So basically, this is kind of the traveling is covered here. And the mode 3 is that commercial presence, or you can set up some service provider in another country, and this is the thing. And mode 4 service is that temporarily persons are moving to that country to provide the service there. Okay, so this is the things. And on the right hand side, you can see that in Korea, service export, basically the mode 3 and the mode 1 takes the most of the thing. Okay. And when you look into some more subsectors of the service sector, then what you can see here is that on the top you have the trade-related services. So basically, this is something when you sell goods to other countries, then something is some services should be attached. So this is something we have here, and so that service is more from the mode 3. So you set up some company or subsidiary over that country, and in that country you can set up you can spend some provide some services related to trade. Okay. And transport, and one thing you can see here is that basically construction was related to the mode 4, because you send some construction workers to that region and provide the service. And tourism and the business travel, we can see that this is more related to mode 2 things, right? So this is Korea's 2022 numbers from Korea. And what you can see here is that when you think about, say, more like this IT sector, right, and their insurance and the financial services, there's so much more rooms that the Korea can try to increase the productivity on this side. So maybe more looking at the more details on this service sector will guide us to find a good policy to encourage the bolster the productivity at the end of the day. Okay. Well, thank you.
Thank you. Okay, so we have 20 minutes left, so I'll give each of you 10 minus alpha minutes so that we can use 2 alpha minutes for floor discussion for your benefit, okay? You decide alpha yourself, okay? Okay, Alistair first.
Okay, my alpha is going to be quite large if I understand the arithmetic correctly. I think the commonalities of what I hear are definitely agreement about the importance of demographics and the challenges it poses to do something else. Something else could be increasing participation. Something else could be increasing productivity. This is the point where we tend to run away because we understand very little about how to produce increased productivity, and we don't understand very much about how to increase participation either. This brings me back to the point that I said in my presentation, that when we look at the conditional convergence regressions, there's a country-specific factor that comes up significantly.
Right.
We just don't know what that country-specific factor is for each country.
I see.
And it's very non-transferable. So that's very frustrating. I think this is a point as macroeconomists where we really need the microeconomist to help us.
Okay.
It's something that I think, for myself, speaking personally, the work I've been doing recently on low-income countries really teaches that at this point our macro policy advice becomes very micro. To pick up on something that Johannes had said, you have to go through the tax code. You have to go through the market regulations. I'm reminded of, to pick up another example about participation, I'm reminded of when I was working on the Czech Republic, of how we eventually determined that the reason why childcare was not available was because zoning regulations made it really difficult to open a creche near workplaces. So I think that's the challenge for us, that we really need to get it down to this level. But I'm hearing a lot of concern. I'm glad that we're talking about the same subjects. I'm of course not so glad to hear such a level of concern.
Okay.
But I think we need to continue in this vein considerably.
Okay.
Thank you.
Okay, thanks, Alastair, for candid discussion. Okay, Professor Han.
Okay, thank you for the wonderful discussions. And the first one, Dr. Wiegand, thank you for sharing the experience about Germany. But when I heard your comment, I'm kind of getting puzzled because you said that kind of Germany has the school ends at before 1 p.m., right? And have a joint tax filing, right? Korea school ends after 1 p.m. and has individual tax filing and still have a very lower female labor supply participant. So this is gonna be kind of puzzling part that we all the Korean economists has to be working deeply. And actually, I realized that some of the figures that Sonyoung gave us has some kind of clue there, because like she shows the working hours between the married and singles, and also working and non-working, difference between the number of the child or something like that. So the labor market, institution of the labor market or the working environment might be the more important for the Korea. The system, I think it's going to be more ready there, but the social norm or the other kinds of stuff in the labor market has to be more deeply understand to figure out this lower female labor supply. And moving on to the Professor Ohm's comments, thank you for your the comments. And actually, one of the comments about your labor quality is correct. I didn't control for the labor quality. The human capital this year is only based on the years of schooling, so there's no like labor quality difference across the life cycle profiles. So when you have the different life cycle profile and when you have the demographic change, then it's gonna be the labor quality in that dimension is gonna be also affected. So that's gonna be the good way to improve the paper that I presented today. Thank you for that. And yeah, that's it. That's pretty much. Thank you very much.
Okay, thank you, Professor Han. Okay, so we have about 10-15 minutes for the floor discussion. So any comments? We have the microphone waiting. Please raise your hand if you have questions. So, yeah, please.
Okay, Sarang Song, a researcher from Kiev. Thank you for doing this. I have a question to Professor Han. So you pointed out the M-shaped pattern in the female labor force participation and encourage, so suggest the policies such as encouraging the employment among married women. But so in slides 28, but what is more stunning to me, if I look at the graphs on both sides, is that in Korea there is the younger age labor force participation rate is extremely low compared with other compared with other benchmarks. So, and I think it is a little bit more pronounced for male than female, considering that they need to fulfill the military service in younger age, like less than 30. So I think at this point we got to think about any policy to encourage younger people to get a job earlier. So any thoughts on this issue?
Oh, okay, so thank you for the interesting questions. So from age 15 to all the way up to the 29. So mostly in Korea, as you guys already know, that there's a complementary education system all the way up to the high school, and there's going to be a very high college entrance rate. So most of the peoples are at the school. So that's the why do we have a very lower labor force participation at the very young. So in order to fix that problem, I don't know, like we need to change the education system or something like that. But if you are pointing out, or after like graduating the college, still there's some room to improve for the younger workers to be more employed, and that's gonna be another dimension that we should focus on here. But in terms of the main reason that I was focusing on the married woman was, like, if you are making the young single woman working longer, then it's gonna be also having a negative impact on the fertility rate side too. So the basic idea that I was proposing here is, if you make the married woman more work more and they have a more child-friendly workplace around here, then the drop, especially when you move into the married period and having a child, then they will not drop it out, and that's going to be kind of huge impact on the Korean economy. So that's the point that I was making here. Thank you.
Any other questions? Yeah, please, in the front.
So my question goes to Dr. Scott. I'm going to ask from macro perspective, not micro perspective. So according to your data set, it's from 1990s or until 2018, right? So it's still early to ask, because nowadays we are using big data, AI or something like that. So we don't know how they will have an effect on, for example, structural transformation or our productivity or something like that. So, for example, it took a lot of time for advanced economies to move from agricultural industry to service industry. But in general, on average, the Asian economies are transforming much faster than what the advanced economies have gone through. So maybe those big data environment or new technology may have an effect on the speed of transformation or the way of transformation of industrial structure. So if you can give us some insights about those kind of questions, so it would be great.
This is an excellent question, and like all excellent questions, it needs. Well, how much time have you got? And I'm almost surely not the person to comment on this. We do have a box associated with the analytical note on AI. But let me parse out different things. My reading of the literature is that the current assessment by people who are very, very smart is on the growth impact of AI is all over the place. And that's really important, because we think that we'd like to think that the drivers of structural transformation come down to the relative productivity in a sector and the relative price of the outputs. So we really need a fix on how is AI going to affect the relative productivity of services, modern services versus manufacturing. And you have some very smart people who say it's transformational. Then you have people like Darren Acemoglu of MIT who says it's going to be 0.1% over 50 years. So I think the honest answer is that in terms of trying to think of how much does something like AI, big data, etc., have on potentially altering the course of structural transformation, we don't know. However, we do know some things. We've been doing a lot of work, and the annex to the note applies this specifically to Asia Pacific. We have something to say about the exposures of employment by category to AI. So we know that some jobs are more amenable to, there are some jobs for which AI is more likely to be a complement and boost productivity. And then there are some jobs where AI is going to be a substitute for that person. And what we see in our analysis is reason, and gives us reason for concern, is that the composition of employment by country generally shows that countries that are already richer are those that are likely to benefit from the complementarity of AI. And you could reasonably think they are going to extend more into services and take advantage of AI than lower income economies. So whereas structural transformation, looping back to the beginning of one of my slides, structural transformation had been a great force for increasing labor productivity and boosting convergence of countries. The worry is that this new wave of technologies is going to reverse that. So that brings us back to the importance of boosting human capital and making sure that when we give advice to countries of lower income, you know, we spend a lot of time talking about budget planning and so on, that we carve out the space to make sure that education budgets are preserved and directed in the right way. That brings us into a whole conversation about active labor market policies and how successful they are, which is a huge debate and gets very micro. But it's something we definitely need to pursue. So, sorry, I took a long time to ask a question, but it's a very far-ranging and very good question.
Okay, thanks, Alastair. Last mini question, last one. Okay, Professor Kang, yeah. Oh, go 1 second.
Thank you very much. Mr. Scott, I think your presentation is quite impressive to me, and as well as the reason why is the Korean National Assembly Research Center there and KDI is now talking about the TFP rather than the labor force productivity as a whole. So, what is your your comment on the to figure out the growth potentiality for a certain country, instead of looking at the labor productivity? What about to take a look at the total factor productivity? Includes all kinds of the unobservable factors that include labor unions, stuff like that, social cohesion, and these all things are the more important, as far as I know, the factor for growth potential. So I'd like to know your comment on that.
This is another great question that goes in several directions. So I'm trying in real time now to just organize some structure in my head. Just as a practical matter, I'll just start with as a practical matter. In the analytical note, we talk mainly about labor productivity when talking about structural transformation. That is not because we somehow favor labor productivity instead of TFP as a measure. It's simply because we do not have data on sectoral capital stock. So that's as far as we can go. So that's just a constraint in the way we approach things. I'm going to take your question, though, as talking about another issue. For much of a period of talking about structural transformation in the literature, and indeed my own presentation is guilty of this, we talk about value added and employment as more or less synonymous. You allocate people and you get product out of it. I think we're entering a phase where the difference between the output from a sector and the employment in a sector can possibly diverge. And so this goes to your question about welfare. One of the exercises we do in the analytical note is to say, well, how much would trade have to expand just to maintain employment in manufacturing across Asia Pacific? And we say that it would basically have to increase 150% from here over the next 10, 30 years, which loops us back to all of the discussions we've had about challenges from fragmentation. The point is that just to stay still as a share of output, manufacturing with declining relative price as a trend will have to increase in efficiency and basically shed labor. So Now then, where are these people going to go, and what are they going to do? I've been talking about the convergence benefits of modern services like ICT and business processes. But there's going to be an awful lot of people who won't be able to work in those sectors. What are we going to do for those people? There's an essay by Danny Roderick and Joe Stiglitz. I don't know if you've seen it, just came out a few months ago, which talks about exactly this problem, that where governments might need to have a whole new set of not industrial policies, but social policies to think about as people move away from manufacturing. Even if manufacturing output stays at its level, as people move away from that sector, and they can't take advantage of the super high skill modern services, what are we going to do for them? We certainly don't want to leave them behind, because I think we know what happens to societies when people feel left behind. It's going to be a big challenge.
Okay, thank you. Okay, so this concludes the second session. So I'd like to take this opportunity to thank the Vice President An and other economists and researchers of the KIEP for putting on such a great conference, and especially the staff inside and outside this room for making this all possible. Thank you very much.